Thanks for joining us here on the Retirement Income Source, where it's always about investing for income the old-fashioned way. I hope you stay tuned for the day because we got a lot of information we're going to cover, but keep in mind, when I say income the old-fashioned way, what we find is, especially when people come in and do a retirement risk report, they finally realize the distinction between growth and income. You know, in our firm, that's what we focus on. In other words, we specialize in it. If you think about it for a moment, there's a lot of specialists out there, right? If you think of Cleveland Clinic, you think of heart specialists. Even here in Lexington, Kentucky, we have certain specific doctors, for example, a chiropractor, for example. That's a specialization. A general practitioner is kind of a general specialization, but knows a lot about a lot of things. But when you get more into retirement, you want something a little bit more specific than that. In other words, something if you think about it for a moment, just like your job that you've been maybe working for 30 and 40 years, you probably knew it inside out. Matter of fact, you knew it so much that it became second nature to you. And that's what I mean by specialization. Pinpointing. In other words, if you're looking at a dartboard, we're talking about the bullseye of the dartboard. That's what I mean by specialization. Specialization in the world of income. And there is a difference, people. And, I see a lot of income options out there. And trust me, advisors don't want to lose the opportunity of not being able to acquire you as a client. And there's nothing wrong with that. And a lot of great ideas out there. But when it comes to investing for income, I hate to tell you, but there's really only two ways you can get income this day and age. Either you're going to return your principal to you monthly, usually anywhere between 50 to 70% of your withdrawal is just your money itself, what took you so long to build, and then the rest of it comes from true income, what I'm talking about specializing in, where you're actually getting something, a return on your money, and it needs to be a positive return every year, right? Even if growth doesn't come every year in a cooperative manner, we're hoping it does. But there's always a plus and there's always a minus in that category, and we got to realize that if you go into retirement and you're relying on growth, you could be very disappointed if growth does not actually cooperate the way you hoped. The 20 years I've been working with people in retirement, and I can tell you right now, I bet I've had over 2,000 meetings, and like I said, specialization in my case is I wanted to have the right team. I can't be everything to everybody. But my goal is to be able to make sure I have the right team behind me. And we decided several years ago that it's best to have analysts watch our clients' money versus me trying to do it. Because all I'm doing is guessing. Maybe my guess may be a little bit better than yours, and don't get me wrong. at the end of the day, we are kind of guessing, especially when it comes to growth, because you don't know whether it's going to come or not. But when you specialize for income, it does require a specialist to be able to do that. It's not something, that you just pull out a manual or a book and go study and think it's going to overnightly or like a pill or something you take and just overnight, it all appears to you and gives you the clarity you need to be able to have the retirement you want. And speaking of that, the name of this show today is Creating a Stress-Free Retirement. How do you do that? How do you have a stress-free retirement? Don't get me wrong, we have a lot of things to stress about. Whether it's politics or whether it's inflation or whether it's your children, you're hoping your children, come out well. And speaking of that, our kids have done, very well up to date. But I'm always, kind of concerned, am I going to have to help them somewhere? And like my son right now, he makes really, really good income, but it's kind of sporadic. There is times in the type of job he's got. He's a lineman, and he chose to be more of a union like type guy. And by being in the union does not mean he's always going to be working. There's going to be pockets of time. I mean, he just got back from that storm that happened in North Carolina and Florida over a month ago, and he did very well. But now he's came back and he has no income coming in, even though he made quite a bit of income while he was gone. So, at the end of the day, I know if I don't have income residually coming in, that to me is stress-free. I would be really stressed out. I don't know about you if I was in his situation, because you don't know when he's going to get called again. Yeah, he makes calls and tries to do his best and be persistent about getting back out and working and stuff, and he will make money when that happens. But there could be, maybe a couple months there that he's off. He's not taking not making any income at all. And, those bills just keep flowing in, right? I mean, at the end of the day, when it comes to going forward, we have a lot of things we can stress out about. But, to create a stress-free retirement, the first thing you have to do is you have to know where you are. And are you ready to retire? If you're a pre-retiree thinking about retiring, or when should you retire, that's another reason why you want to call in and get the retirement risk report. And that retirement risk report is a simple one-pager. It helps you to understand where you are. We've had several people that would actually, go through the report and the analysis and didn't realize they were actually ready to retire. Even though they may not retire when they, immediately, it's nice to know that you are ready to retire and you're prepared for that. The last thing you want to do, is to go into retirement thinking you got everything ready to go, and then all of a sudden, you missed the boat and so forth. And the last thing we want to do is have a retirement that winds up being something that we may wind up being more stressful about, especially as we get older. Early on, most retirement plans works out pretty well. It's the mid-range and the long range that you got to be more concerned about, is where is that balance going to be down the road. And this retirement risk report really helps you to do that. It helps you to understand what real income is, so that way you can have the stress-free retirement you want. And you can call 888-930-1080. Again, that's 888-930-1080. And you can schedule that 30-minute phone call. That's where it starts first, so that way you can be on the road to prepare for a stress-free retirement. And today we're going to actually be covering stress-free retirement from several plans that I've actually been in front of. We've been busier than a bird dog, especially in the last few months, and right now I'm really struggling trying to find time for myself. I'm even having to come in on Saturdays, and that's good. That's a good thing and a good problem to have. But at the end of the day, it's all about making sure people have stress-free retirement. And so you want to be able to reach out, again, 888-930-1080, and get that retirement risk report, so that way you are on the right path. You got to keep in mind, I get it. Most of us are going to check around and see, who's going to be a better service for our retirement needs. And I hope that everything works out for each and every person that's out there. All I say is make a pit stop here, because what we have found is we're doing something different than most people are actually seeing out there. And so it's really worth at least seeing, so that way you can make a determination. Not only that, it makes you a lot wiser about your money. And, just like my book, the retirement income shift. At the end of the day, what do I mean by income shift? It's a shift we need to make. And most people, when they go into retirement, they don't make a shift, not realizing that that what made them successful in accumulating wealth, they think they can utilize the same strategies to get them through retirement. And those are totally two different stages in life, because after all, the accumulation stage, I think, in my opinion, is extremely easy. All you have to do is have a disciplined contribution each and every month, you and your employer both. But you got to keep in mind, when you go into retirement, both you and your employer quit contributing to your retirement plan, which assisted you in accumulating wealth. You got to keep in mind that accumulating wealth is about buying shares, and you're buying low over time. That, as we all know, is the way we all get wealthy, right? We buy low and we sell high. We've heard that. Well, when you go in retirement, you actually lose the contributions. Those goes away. And the only thing you got left is a return on your money. And you need, if you're going to take income from your portfolio, do you want a positive return you can count on? Or do you want a hopeful return that you don't know whether will happen or will not happen? Because you need totally cooperation of the markets. And we all know you cannot will the markets to go up. And since most portfolios we examine with the retirement risk report, what we have found is the portfolio, it's the type of tools they're using, primarily mutual funds or exchange traded funds, which are deficient in income. Yeah, they're okay. They may even have 5 stars when it comes to the top of Morningstar ratings. That's irrelevant, people. The question is, you know, you can have the best quality funds and still spend your principal, and when the markets go down, you're still going to spend your principal at a faster rate. It doesn't really matter. The question is, do you want to avoid that? Do you want to minimize spending principal? Because at the end of the day, you're trying to get the most mileage out of your money. So if you want to know more about income first methods, in other words, if you want growth, you focus on income first, because income is the problem you have going into retirement. So if you get income, you will get growth. Growth will follow. And I got a great book I want to get in your hand, my new release book, The Retirement Income Shift. And it made Amazon bestseller within about 7 to 8 days after release, just about 3 weeks ago. And it talks about the strategies that are geared toward interest and dividends. In other words, what will make you successful? And again, what's more important is having a specialist that actually knows what they're doing, because this is not something you want to try at home. It's not as easy as fixing the drain on your sink. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll get this book out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks. We'll be back, and we're going to start exploring different retirement plans that we've recently met with. I'm going to go through 5 of them today as quickly as possible, so stay tuned as we go through that for the rest of this show. Welcome to the Retirement Income Source. This is Tim Sparks, your host, and today's show is sponsored by Sparks Financial Group right here in the heart of the bluegrass, Lexington, Kentucky. Today we're talking about creating stress-free retirement. What does that mean? We all want stress-free retirement. After all, as we're getting older, stress is a thing that we need to be more concerned about from a health perspective as well, because that is not good for our heart. And we know that as we get older, our heart gets weaker, and the last thing we want to do again is have a less stressful or more stressful retirement because we're doing it the wrong way. You know, keep in mind, I read about this article years ago, and it was talking about how people, I'm talking about retirees, people that are in retirement, and I want to say this was after the financial crisis, about 92% fired their advisor. Now, the advisor had nothing to do with the markets going down. What the market, in their mind, what the advisors did not do was help them to be able to get through and migrate through those negative downturns. And see, people, at the end of the day, it's not necessarily about the positiveness of the returns of the market, right? When the markets are going up, we're all excited. We're high-fiving in the streets, probably in our mind. We go out and we just wipe sweat off our brow for one more day and say, okay, great, today's over with, and now we got a new day tomorrow. That shouldn't be the way retirement should be. We want to make sure it's more stress-free. It's not about worrying about your balance. It's worried about, are you spending your balance for the purpose of income? That's different what I just said. You see, your balance can create income, or your balance can be part of your income plan, and you have to decide which one of those you want to be on. And most people are actually spending their balance, and therefore they're not getting very much income at all from their portfolio. And just a proven point, we talk about total return equals I plus G. This is a formula that most of us have probably heard of, but we probably disregard it, and it's the very key formula that's going to make a difference of whether your money is going to outlast you or not, in my opinion. And not just in my opinion, if you just break it down, you'll come to your own conclusion. It makes a lot of sense, because interest and dividends are paid to you on a quarterly basis. Some of them are paid a monthly basis. Some are paid every 6 months if you have actual bonds. But at the end of the day, I is coming in residually, kind of like a landlord that collects rent. If you're going to collect rent, then you're going to be by far better off than you are if you go into this next category of growth, because you're dependent on growth, and growth you can spend growth when the markets go down, but you probably got to realize that that's probably not the best thing for you to do. You actually don't want to spend principal at all, so that way you can get growth. And how you get growth is you invest for the I. So just think of it like this right here. Look, let me tell you how a return is made on a particular portfolio. I had a guy the other day tell me that his advisor told him he's up $168,000 for the year. I said, well, did he tell you what he made you in 2022? He says, no. I said, go back and demand that you get that answer as well, because see, I know what's going to happen. He's going to give him a negative return. And you got to understand, people, I get it. Don't get me wrong. We like the positive returns. We want to remain optimistic. But at the end of the day, you have to be prepared, not if, but when the markets go down, are you going to be okay with it? Because at the end of the day, you can have losses that could occur for several years in a row, called a recession. And the recovery, or just recouping the money you once had, can take a while. It can take as much as 13 to 25 years. That is the time frame for negative growth periods, where there was no return for a long length of time. And that's not the first time it's happened in the last decade, early 2000s. It also happened ever since 1899 till 2020, or 2000 itself. So in other words, it's happened 3 other times. So you got to keep that in mind. So here's the formula. What most people we see when we do a retirement risk report is they're getting about 1% from the I after they pay their financial advisor. So that's a given. On $1 million, that's 10 grand. The client needs 50 grand. So they're going to have to spend 40,000 of their own money. That's what I mean by spending their balance. And if you want to make 8% on your money, on average, you got to make 7% in the growth column. So if you're getting 1, that's the only thing you can count on. That means the growth, the G, has to make 7% each and every year to you to feel confident in an average return. We keep hearing the word average return. And by the way, I know people that will spreadsheet it, and they'll say, well, I'm averaging 8%. I said, well, let me tell you how you break that down to be able to, so that way you can know if you're going to get that or not. Because at the end of the day, and I know that doesn't happen. The markets doesn't consistently go up. If that was the case, we would never need to give investment advice. So if you get 1 plus 7, that's 8. But if you get, let's just say the flip side of the coin, you're getting 5% from the I, and you only need to get 3% from the G. Well, if you need $40,000 or $50,000, now you're getting it from the appropriate formula of the interest and dividends. Therefore, now you can get growth. You got a better chance of getting growth. Why? Because you didn't spend your balance like you did in the first. So you got to keep that in mind whenever you're actually taking withdrawals. How much do you want to spend of your principal, or you want to reduce or even eliminate spending principal altogether? So how do you know? Well, first of all, you have to I'm going to get something in your hand. Total return equals I plus G. And hopefully maybe this may help you by looking at your statement. If you don't know exactly how dividends work in your statement, then I would encourage you to call our office and set up for a retirement risk review, and we can actually show you that. And again, if you want to have that report, call 888-930-1080. Again, that's 888-930-1080. And we'll mail that to you or email it to you, whichever you prefer. Again, 888-930-1080. This is the retirement income source. This is Tim Sparks, and today we're talking about creating stress-free retirement. You know, it reminds me of a shire issue I had several years ago, where, you know, when it comes right down to it, the last thing we want to do is make a bad decision, right? And sometimes we don't even know if we're making a bad decision until we actually accept or actually do a little research on our own. And so we always encourage people, listen, you don't have to use our services. That's not the point of this right here. I'm not going to lose sleep because you don't call in and use our services. But I'm willing to bet you 99% of the time, or at least based on what I've seen, the majority of the time people are actually spending principal in retirement and calling it income. And this is exactly what happened with this couple. This couple, when they came in, they already had a retirement income plan. They've already been in retirement for several years. And they knew about our firm, and actually they had a friend that recommended them to at least take a look at what we do. And, they're utilizing our service and our income like portfolio that we specialize in. So they came in, and we actually looked at their portfolio. And the most common portfolio I've ever seen is still what I'm about ready to explain to you. They had about $600,000 in annuities, and they had about $250,000 between cash and money that was being managed for them. So they're way overweighted into annuities. Now, it's not like annuities are bad. But at the end of the day, it's what's going on in a retirement plan that was a concern of mine. What they're doing is they're taking out $30,000 a year from the $230,000 account and just leaving annuities alone. And these annuities are performing okay, but they're not really performing that to make up the return the withdrawal rate that they're taking right now in their current portfolio. I mean, right now they're taking out $30,000 from $230,000. That percentage is about 13% of the account. So in other words, in 7 or 8 years, that balance is going to be depleted, and they got to hope that they make up that $230,000 with the 3 annuities. And I'm going to be honest with you, I don't think it's going to happen, no matter what they do. And at the end of the day, they just spent their principal, and they're using what I call, maybe it's a bucket strategy. I don't know the method of madness with the advisor group that was actually utilizing this strategy, but they apparently were comfortable with it. And people always ask, always tell me, so my advisor tells me I need to take withdrawals, and this is where I need to take it. And I said, okay, well, that's fine. But I said, the question is does it logically make sense? And of course, at the end of the day, we should be making our decision logically as well, and let the math be our guide. And so when we started breaking down this portfolio, they're not taking any income from their annuities. Again, they should be, but they should be doing it strategically. And since the annuities have returns that are between 0 and 10%, it's really hard to know. And these were a form of an index type style annuities. But the first point I want to make is 13% withdrawal rate out of one account. So they're sacrificing one a portion of their money, which is just giving up principal, when really and truly they didn't really need to do that. They're taking out $30,000 a year, and they can actually earn more than that in interest and dividends with their whole portfolio. And if you add everything together, they had about $821,000. Why in the world would you want to spend $30,000 of your own principal if you can avoid that? So I want to get a book in your hand based on income first methods. In other words, if you get income first, you'll get and growth will follow. And the name of the book, my book, Retirement Income Shift. It's only been out for a few weeks, and it's already made Amazon bestseller, and it's a great read to be able to help you to get on the path for a stress-free retirement. And I got a free copy for the first 5 callers of today's retirement income source. Call 888-930-1080. Again, that's 888-930-1080, and you'll get this book if you're one of the first 5 callers. Again, that's a free book, no obligation, 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks. We got more coming just in a minute. Thank you. You're tuned in to the Retirement Income Source. This is Tim Sparks, and this show is sponsored by Sparks Financial Group, financial firm right here in the heart of the Bluegrass, Lexington, Kentucky. Today we're talking about creating stress-free retirement. How do you have a stress-free retirement? Well, it depends. It depends on what people would call stress-free. From a health perspective, as we get older, our heart gets weaker, and stress is the first thing that will put us in the grave faster than anything. And that's, if you think about it for a moment, when it comes to our wealth, we also need to understand what will cause us to have an unhealthy lifestyle will depend on the stress, and that's most importantly the retirement that we have, because a lot of times people don't realize that they can actually minimize and have a clearer path, more clarification on what a good stress-free retirement should look like. And that reminds me, I have this couple I was talking about a minute ago and didn't really get to complete my thoughts on this. They had $590,000, almost $600,000 in particular annuities. Really wasn't taking any income from these annuities. Problem is these type of annuities do not earn ongoing interest or dividends because of the type of instruments they are. Now, there's annuities out there that pay guaranteed income. There's annuities out there that pay interest income, but these type of annuities are relying on performance of the index. And so, to me, it's like unnecessary. It didn't even make sense in these people's situation. Now, keep in mind, I have to be mindful of people's risk tolerance. There might have been a reason why they bought this annuity from that standpoint. But at the end of the day, he and her both wanted more income. And they're actually getting it right now. The problem is, it's where it's coming from. They're reducing their principal by $24,000 a year, and they're taking it out of one bucket, they're one source, and it's out of another account that they had that was being managed that was worth about $230,000. And I'm breaking it down. We did a retirement risk report, and they're getting about $7,000 or $8,000 in interest and dividends from the $230,000. I got to subtract an $1,800 fee, which is about 1.25% of their account value. And at the end of the day, their net income was around $6,000 or $7,000, and they needed $30,000. That's their withdrawal out of this particular account. Therefore, they're reducing their principal by $24,000. Now, logically, that wouldn't make me feel good, because at the end of the day, that's not a stress-free retirement. Stress-free means you should be taking income from interest earnings only, not from your own money itself, because it took this couple about 33 years to accumulate their wealth, and they're at the rate they're going right now. They're going to go through it quicker, because you got to keep in mind, people, today's income withdrawals are going to need to be increased for future inflation. And if you're reducing your principal, you're losing your inflation hedge. There's no way around that. No matter what you can slice and dice it any way you want to. It's like a small cancer, and it evolves into a larger cancer until you get to the point where you got stage 1 converts more to stage 3 or stage 4 cancer. And nobody wants to go through that type of stress, especially when you could have avoided that altogether. So what was their alternative? Well, we showed them that they just put all their money to work, annuities and all, and just earning interest and dividends in an ideal scenario. Keep in mind, all we're doing is we're doing a comparison, apples to oranges. Our clients are getting on $820,000, $35,000 to $40,000 a year in interest income. I said interest income. Interest is what you're earning on your money. Just like a landlord that had an $820,000 fourplex, if they're collecting $35,000 to $40,000 in rent net to them, that's money they can spend. Therefore, they'll get the growth when growth actually occurs, because they're going to get it from capital appreciation. They're not spending it, so to speak. And because when you're investing for growth, you're selling growth. You're selling shares, and it's the same problem. And so you're reducing your shares, and so therefore your shares get minimized, and you're doing it on a monthly basis. And then when the markets do come back, you've lost some shares, so that part of your portfolio is not going to grow anymore. So you're slowly but surely whittling your portfolio down until your balance gets to the point where you're going to start pulling your hair out probably, or start getting really aggravated for why this actually, maybe could have been avoided. And so that's the whole goal, is you want to be able to avoid it. And so, just like my shower, I had a shower issue years ago, and we spent over $25,000 to $30,000 to get my shower, it's a custom shower, fixed. But I had 2 different water leaks. Both time it damaged the floor and everything. And so the third time, by the time I fixed it the third time, I got involved. And just like we encourage people with the retirement risk report, getting involved helps you to understand what the problem is. And so that's what I decided to do. I wasn't going to take just somebody's word for it, a combination of a plumber and somebody that actually puts tile down and everything to get my shower back up. I wanted to get involved as well. And so the more we dug, the more we felt like that a particular system that they got out that actually came out, and that they can probably wrap before they start putting their tile and so forth. But anyway, I'm really confident now that our shower is not leaking like it did, and that's the same way here. We don't want to have leaks in our retirement, and we could have avoided it altogether. Keep in mind, it's all about what? I don't want to have to go through that additional cost again, because that might have been a $10,000 cost, but when it comes to your retirement, that could be even more expensive. So if you'd like to learn more, in other words, how do you protect yourself from the dangers of inflation? Now, the reason I say that is because if you're spending principal, you're not protecting yourself right out of the gate. You've already got something against you. Spending your principal minimizes you don't get no inflation hedge, I should say, because you're reducing your principal, and the principal you have left, it's hard to grow it back. Just like a farmer that sells their acreage, if they continue to sell their acreage, they have lesser acres, and then when they went and did an appraisal, and I know that as the acreage continues to reduce, the value that they once had is going to be less than what it would have been. That you need an inflation hedge, and this commission report can be yours. Again, it's protecting yourself from the dangers of inflation by calling 888-930-1080. Again, that's 888-930-1080, and we'll mail this to you or email it to you, whichever you prefer. Again, that number, avoiding dangers of inflation, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks, and today we're talking about creating a stress-free retirement. Well, I just ran across a couple who was referred to us, and they wanted, first of all, what I picked up on was they wanted to reduce their risk in retirement, but they also wanted income. because I know how much income they were living on when they came in, and I knew that the income from Social Security was not going to be enough. So they were going to need their portfolio, and they had a significant amount of money. They had about $1.2 million. And so out of the $1.2 million, and they've been with this advisor for quite a long time, and they really liked the advisor. But at the end of the day, they said when it comes to their money, they want to be able to make sure that they're making the right decision. And I kind of got to talk to these people just because they were more referred to me from some of their best friends of what we're doing for them. And so we did an examination of portfolio. And again, that's what today we're going to be talking a lot about throughout this show. And I've got very little time to go through this. But at the end of the day, they needed $30,000 a year to be able to do the things they wanted to do. When we looked at their portfolio, they were only getting about $6,000 a year in interest dividends net to them. Keep in mind, people, interest and dividends are paid to you regardless of what the markets do. The markets can go down, you're going to get the same amount. If the markets go up, you're going to get the same amount of interest and dividends. Because what people don't realize is accumulation to some degree stops unless you get capital appreciation, because most people's retirement plan is hinging on that they're going to recover their withdrawals from the growth principal, and the growth principal sometimes don't turn into growth, it turns into a loss. So right out of the gate, they were taking about $24,000 a year of their principal if they stuck with the current retirement plan. I mean, and I told them, I said, this is not bad. At least the risk tolerance is down compared to what, most portfolios we've seen. But at the end of the day, they don't feel comfortable even spending $24,000. But here's the kicker. They want their risk not to be no more than 10 or 15%. In other words, they don't want to see no more than 10 or 15% loss. And whenever we did a stress test on our portfolio using the retirement risk report, it was a big eye-opener. They could lose up to 33% or $300,000 of their money. They say that's totally unacceptable, but that was the portfolio that was suggested to them. And not only that, the advisor, who was kind of young, really didn't want to make any changes. And if you find somebody that's resistant to change, you better be getting out of Dodge, because that's, if you don't know what your stress test is, at the end of the day, you're going to be stressed out, and you're not going to have a stress-free retirement, not unless the markets just cooperate going forward. But these people didn't feel confident that the markets can always do that. And so stress test is just basically taking your current holdings and looking back in time and saying, just like kind of like the financial crisis, those particular mutual funds or ETFs went through the financial crisis, and you want to know what was the impact to these particular funds, so that way you can be prepared just in case you may not want that. In order to reduce your risk, you're going to have to change. You're going to have to change your type of strategy, which is exactly what they wanted to do. Also, the retirement risk report divulged their fees that they were paying. Now, the fees were reasonable. They were using, mutual funds and exchange-traded funds were highly rated, and they were institutional-based funds. So the financial advisor was a fiduciary, was playing a fiduciary role, even though this was kind of a hybrid role type of advisor. But the mutual funds itself, when we did analysis, was costing them just under 0.5%. So they were paying about 1.5% a year to be able to take the risk of losing $300,000. They needed $30,000 in income, and they were going to have to spend $24,000 of their own principal. And I don't know about you, that means they had a lot of risk there. That's not a stress-free retirement, because they're already going to run the risk if they can lose money, let alone paying 1.5% to do that. And at the same time, they're going to take $24,000 of the principal in an up, down, or sideways type market. And I told them, I said, the plan would work if they can get $24,000 recovered from growth each and every year, which in their case, they already know that they're not going to happen, especially with the stress test coming back and saying that looking back, that it did not happen. And going forward, We don't know. And if you don't know, you want to know what that number is. What is the stress? What are you willing to lose? So we reduce their fee between 0.5% to 1%. That's the range we give people. And the biggest reason why, because we don't know exactly what type of strategies they want in their type of portfolio. But most importantly, how do you reduce the risk at the same time? And you have to use contractual instruments like bonds and bond-like instruments to do that. You see, what they had none of those type of instruments to be able to reduce their risk. Because a bond returns their money to you, and there's other instruments that will do the same thing. So, and by the way, we were getting them $46,000 a year, which that means they had a $16,000 per year surplus, a surplus that allows them to continue to reinvest. So now they can not only get the income they need from the proper component of interest and dividends, but they now get a $16,000 a year surplus, which they can reinvest and still buy shares and promote growth. So it kind of worked out really perfectly for them, and they emphatically were ready to make a change as soon as we discovered and went through that retirement risk report. So again, a retirement risk report helps you to see where you are at. Seeing is believing. And if you want to know more about income first methods, first thing we need to do is we need to learn, right? And so you do that by repetition and reading. I got an excellent book, The Retirement Income Shift, How to Get the Most Mileage Out of Your Money, written by your host, Tim Sparks, Amazon bestseller within a week after the release. And it's focusing on income. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, 888-930-1080. And we'll mail this book out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You're tuned in to the retirement income source. 2 more coming up. Here's just a minute. We're going to cover at least 2 more cases here about creating a stress-free retirement by using a retirement risk report, which is exactly the tool. It's a proprietary tool we use, and we like to keep things simple. It's just a simple 1-pager. It helps you to be able to know if you are on track for the days ahead when you're preparing for retirement. Welcome to the Retirement Income Source. This is Tim Sparks, your host, and today's show is sponsored by Sparks Financial Group right here in the heart of Bluegrass, Lexington, Kentucky. Again, we're talking about creating a stress-free retirement. I had a couple come in that really likes income. I can tell because they were already drawing pensions and Social Security, and they still got about $800,000, and they've been taking some money out of it, but not really enough. And they were doing pretty good. They're really successful. They paid their homes off, their second home, and so forth. I mean, overall, they were doing pretty good. But at the end of the day, they wanted more income. I mean, they don't feel like they were getting, and it could be because when it comes to pension and Social Security, it becomes stagnant over time, right? It doesn't really keep up with inflation. And so sometimes, especially in most of the pensions and stuff we see today, the income that they were drawing, 5 years ago is the same it is today. So my guess it was the impact of inflation, and only that, they wasn't getting any younger. They wanted to enjoy retirement. And I don't know about you, but when people understand about interest and dividends and how much more income that they could get, they find out they've been leaving this on the table, and they walk, and then when they walk away, they wish they would have made a decision sooner. I don't know about you. Anytime I can get more money, I'm looking for a way to be able to figure out how to do that, because there's a lot of things out there that we miss out on because we just don't know how money works, and that's that formula: total return equals I plus G. Well, at the end of the day, we can get this couple another $30,000+ a year, and they're like, okay, what do we need to do to be able to move forward to be able to do that? And not only that, this couple does not want to lose no more than 10%. Keep in mind, I got to worry about 2 birds and trying to kill 2 birds with 1 stone, reducing the risk where they want it to be, at the same time getting $25,000 to $30,000 a year in interest and dividends. Now again, people, we're not talking about annuities here. You can't get annuities to pay interest in dividends primarily because annuities don't pay dividends. If you have variable annuities, which are mutual funds inside of an annuity, higher fees. That's not what I'm talking about. Indexed annuities make returns some years, other returns you make zero. That's not what I'm talking about. You can probably get some interest from, or not probably, you can get interest from a fixed annuity. It's kind of like CDs pay fixed rate of interest. That's with a fixed annuity. But at the end of the day, people, that's not what I'm talking about. And that's what they want to do. They want to reduce the risk. And how do you do that? By being in the stock market, where you're stocks and bonds and bond-like instruments. And so that's what we did. We can do that by reducing the risk by being in bond and bond-like instruments. Which brings me up to a great commission report when it comes to risk tolerance and investing for income simultaneously. In other words, you're trying to kill both birds with one stone. You want the risk tolerance, it's one thing, but it's another thing to get the income at the same time. You want both, so that way you can have the retirement, and most importantly, it'll be a stress-free retirement. You do that, I'm going to get this report in your hand by calling 888-930-1080. Again, that's 888-930-1080. Again, that's risk tolerance, investing for income at the same time. And that's exactly just like that case I just now went over. And so what we did for this particular couple, and we actually find that people want to reduce the risk and they don't want their income to change, and there's many ways of doing that by dealing with stocks and bonds and bond-like instruments. And again, call 888-930-1080 and get that report. Again, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks, and today we are talking about creating stress-free retirement. We went over several cases throughout the hour, and we've got a little bit of time just to squeeze one more in. So I had a couple call in. They had about $1 million, and when they called in, they were really content with where they were at. And at the end of the day, I hope that they're getting the advice they want. But at the end of the day, they got to get the advice that makes more sense to them. And that was what they were concerned about, because when they heard me on the show talking about interest and dividends, they immediately, just like most people probably do, pick up the phone and ask their advisor, am I getting interest and dividends? If you ask it in the right context, you will get an answer that's no, every time. But here's what happens. They immediately get on the different horse and ride. In other words, they're going to say, you're up 160,000, or you're up 200,000 this year. And people, I'm glad for them. I told them, I said, listen, getting 200,000 is, that just basically means you went up, your portfolio went up in capital appreciation. I said, but what we're talking about is how much interest and dividends did you get of that 200,000, for example, or 150 or whatever. And not only that, if somebody's going to brag about the positive numbers, and by the way, our clients went up that amount of money too, but they also got the I settled in the proper component because they need income too. This guy doesn't want to spend principal because it makes a lot of sense. And so what we did is basically, I kind of covered this over the phone, and they were taking out about 40,000+ a year, and they're getting about 10,000 to 15,000 in interest and dividends. By the time they subtract the fee, they're only getting about $7,000 or $8,000 in net dividends, which means they're taking out over 35,000 a year in principal. Now, this person's been with this advisor for quite a long time, and really struggling with how to divorce the advisor if they choose to do so. And that's up to you. It's your money, but at the end of the day, you're battling here two fronts here. Do you want your money to last? Is it about you and your retirement and your family, or is it more about staying with your advisor and spending $35,000 a year in interest and principal? And once they understand that even though there was good years, our clients got good years too. It's the negative years, people, that you got to be more concerned about. Whenever there's no growth whatsoever, and that negative number can be pretty significant. Matter of fact, the stress test on this particular client could have been as much as 45%. I don't know about you, but this guy does not want to lose that kind of money. And so how do you do that? How do you reduce the risk? You have to have bond and bond-like instruments. You got to have something contractual to be able to minimize that risk, to be able to get the income. And only that, they were taking unnecessary risk to be able to get the get income that they needed anyway. Because our clients on the same amount of money is getting $50,000 to $60,000 a year in interest and dividends. They could have had a surplus, still going back in and reinvesting and buying more shares and actually increasing their income over time. Therefore, they can have an inflation hedge. Well, we're coming up at the end of the show, but I want to let you know about a great book, Income First. In other words, if you have an income first, growth second mindset going into retirement, you will get your growth, but you can't spend growth and expect to get it, or rely on growth, expect to get growth. You got to be able to have income first mindset, and also the portfolio needs to, most importantly. And I got a great book, The Retirement Income Shift, written by me, myself, came out just about 3 weeks ago, Amazon bestseller within a week, and it talks about how to get into investing for income first. And this book is available for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this book out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. We thank you for listening to today's show. We hope that you learned from some of the cases we shared with you about how to have a stress-free retirement. To have a stress-free retirement, invest for income first, and you will be able to prolong and get more mileage out of your money. Thank you for listening. We look forward to next week for some more great information to share with you.